Have you ever looked back on a stock that you've bought and thought, what on earth was I doing? Well, that's happened to me quite a few times actually. And today I'm going to talk about my worst investment over the past decade. I'm going to share with you what went wrong, the warning signs that I ignored, the blind spots that I overlooked, and how I've adapted my approach since then to make a lot more profitable investing decisions. But before we dive into it, my name is El-Gorr and I'm the founder and CEO of Freeman Publications and investingcoach.com. Over the past 4.5 years, we've helped 180,000 individual investors with our books, training courses, and basically everything else in between. So whether you're a seasoned investor or you're pretty new to the field, stay tuned, buckle up, and I'm going to share with you my worst investment of the past decade and how you can learn from the mistakes that I made. Right, so my most awfulest investment of the past decade was, drumroll please, Beyond Meat. Now, I'm sure some of you watching this may have actually owned this stock at some point, so you may be feeling the pain with me. So I bought Beyond Meat initially in October of 2019. So just after the company IPO'd. And this was my first real mistake, is that I broke my own rules. Now, I don't buy IPOs typically. There is a big reason for this, and it's when a company goes public, you have the insiders who have owned shares while it was a private company. They have what's known as a lockup period of 6 months, 183 days, if you want to be really specific. So they can't sell any stock for the first 180 days that the company is public. What usually happens because of that is the stock price tends to jump a little bit, depending on how hyped the IPO actually is and the overall economic conditions. But then after about 6 months, you start seeing this systematic insider selling. So generally, it's much more profitable to wait at least 6 months after a company goes public before you buy the stock. Now, I violated this rule. The stock had already fallen by 30% since the IPO when I bought it. So I thought, you know what, I think I'm getting a good deal here. But the problem was the IPO itself was actually 700% higher. So by the time individuals could buy shares, it was up 700% from the initial stock offering price of $25 a share. So I paid about $140 a share, which was way too high. And I'll tell you why I paid the $140 a share. So my initial thesis for this stock was, I thought that the tailwinds from the plant-based diet industry would be strong enough to keep propelling the stock higher. Now, the industry itself was projected to grow around 9x between 2018 and 2025. A very small percentage of the US population favored a plant-based diet at the time. And so when you have what is a relatively small market with massive growth potential, you are gravitating towards that sector. Now, Beyond Meat itself was a leader in the space. It was the most well-known company. It was also the only pure play plant-based foods business on the public stock market. Whether that was a good thing or not, I think really depends on the industry, but that was the truth at the time. And it was growing at lightning speed. In the year before it went public, they saw 238% revenue growth year over year. And also, there was some celebrity endorsement, so to speak. Bill Gates was an investor. And whatever you think about Bill Gates on a personal level, because he's a very polarizing character, he's got a very, very solid investment portfolio. Warren Buffett has helped him manage it for a number of years now. And he owns a ton of blue chip stocks like Berkshire Hathaway, Waste Management, Caterpillar, Canadian National Railway. And he's got a very good track record as an investor in public market companies. So his endorsement was another indicator to me that this would be a good chance. You know, I'm looking at the numbers here, and this isn't actually too bad. You know, like I say, 238% revenue growth. It was borderline profitable as well. So it's not like all this revenue growth was coming for a company that was hemorrhaging money and hemorrhaging cash. So I thought, you know what? This company, yeah, it's expensive, but it's growing really fast. It's growing at a sustainable way. You know, if we look at the profitability, and I'll talk more about that later on. So I think this one could really go somewhere. And this is another mistake I did, which was just really a lack of deeper due diligence on the stock. I would assume they'd have figured out the unit economics down the line. I'll be honest, I hold my hands up. I did zero due diligence on how expensive this, quote, fake meat was to actually produce. Just assumed that it would be much cheaper than the production costs of real meat. And if you took company market cap as a percentage of the entire industry as a whole, Beyond Meat made about 60% of it. And this was the second big mistake I made, because they didn't have 60% market share. It was nowhere near that. It was actually around 25% at the time. And so there's clearly a mismatch there in terms of market share and then the premium you're paying for the stock. So that was my second big mistake, and it really compounds on the first one of paying way too much. But let's fast forward a couple of years, and I've owned the stock. I actually did average down a little bit on my position as the stock stumbled. But in any growth industry, there is going to be competition. So that tends to come in three forms. You've got other startups. So in this case, companies like Impossible Foods. You have the incumbents, so existing food manufacturers. So public market companies, you're looking at Tyson Foods, Conagra Brands as kind of like the big two. And then you have in-house variations. So in this case, you're talking restaurants developing their own artificial meat products. So Beyond Meat, there was a lot of talk about these partnerships they had with McDonald's and Burger King that either got delayed or cancelled completely. So they actually lost the Burger King deal to a rival, Impossible Foods. McDonald's did a trial of Beyond Meat with the McPlant, which ended up going nowhere. It was 4 full years before they reintroduced it to the menu and rolled it out nationwide. So the timelines just didn't match up with investor expectations. And this is where I really messed up, because I should have gotten out a lot earlier than they did. Gross margins got worse and growth was slowing down. So you have that perfect 1-2 punch of a death spiral for the company. So I paid, and this is embarrassing to admit actually, as much as 30 times sales. That would be an insane valuation if you're buying a tech company today. This was a physical product manufacturer. And this was also pre-pandemic. So we hadn't quite reached insane mania level valuations across the board. This was in 2019. So that makes it an even worse mistake. And I actually went back and I looked at the valuations that their two closest competitors were trading at the time. And Tyson Foods and Conagra Brands were trading at like 1 to 1.5 times sales. So I paid between 20 and 30 times what I realistically should have been paying. And even if you give them a premium for the growth, it's still probably 10 or 15 times too much. So my mistake in one sentence here, I overestimated every growth scenario. I paid way too much for the company, and I did so in an environment where there was no way that the company could get back to anywhere close to what I had actually paid for the stock. And these are the numbers since then. So if you look here, there's one number on this chart that's really, really indicative of how poorly this company has performed. It's this gross margin number here. So the year I bought the stock, they had gross margins of 33%. Now, for a physical product manufacturer, this is not particularly bad. It is not particularly amazing. But from a growth company, what you would expect, and all of the great companies can do this. They can increase revenue while slowly increasing gross margins as well, because that means they're achieving economics of scale. With Beyond Meat, the opposite was happening. By the time I sold the stock, which was in early 2022, their gross margins had gone negative. So it was costing them more to produce this artificial meat product than they were making from selling it. And that doesn't even include costs like admin, sales and marketing, R&D. None of those are included in gross margins. This is purely the cost to make the product versus how much they sell the product for. Negative gross margins. You can't run a business on negative gross margins. Doesn't work at all. And this is why, today this company is in the toilet. So by the time I sold it, it was down 48% from my buy price. It's done a lot worse since then. But, I'm not going to sit here and pat myself on the back for selling a stock at a 48% loss when it's now down 95%. I still lost 48% on my investment. So, as much as I got out, I could have got out at the worst time. It's still not a successful investment by any measure. But here's what I learned and what I applied to future investments from this. Hyper growth in a one-off year or even a couple of year period cannot be the only metric that you use. I fell in love with 238% year-over-year revenue growth. And I've avoided companies since then that have displayed similar numbers because I know that that's not the only thing we can look at. I paid tech company multiples for a non-tech company. That in itself was stupid. 30 times sales, what was I thinking? I would never even pay that today for a best of breed tech company. I own a few of the more expensive public market tech companies, and even now they're trading at 13 or 14 times sales. 30 times is insane. And just it's a growing industry is not enough. Not every company will be a winner. And we really saw this in the past couple of years with, for example, the electric vehicle boom. All of these companies going public in 2020, 2021, people trying to find the next Tesla, so to speak. And they're buying these garbage companies like the Lucids of the world, the Workhorses, and all of these companies that really had no revenue, no product, but ridiculous valuations because of, the world's going to transition to EVs, therefore every single EV startup is worth paying for. And it just simply doesn't work like that. So here are the actions that I took post my Beyond Meat investment. Now the first one, I'm very happy to say this, I have not bought any IPOs since then. Even when, and this was hard, I won't lie, it was hard in 2020 and 2021 when you couldn't lose buying a stock and seeing it go up the same day it went public. Companies like Airbnb, DoorDash, Palantir up 50, 60, 100% on day one. Not solely relying on industry tailwinds. I've avoided pretty much every hyped EV and quote AI stock since then, especially ones that have just gone public. And the biggest one of all is just placing a lot more emphasis on valuation. Specifically multiples that a company's trading at in relation to the broad market. And there's one investment that I've made since then that really highlights this, and that's Palantir. So Palantir is a relatively small position in my portfolio. It's not a top 10 holding of mine, but I have held it for the past 2.5 years. Now this company went public at the end of 2020. Was one of the biggest hype stocks off of the pandemic era IPO mania. It was trading at 37 times sales at its peak. So just after they went public in January of 2021, it was trading at 37 times sales. Now, I didn't buy it then. In fact, I made 2 purchases of this stock. And because I think proof is important, I actually sent this out to the email list as well. First one was in February of 2022. It was trading at $12 a share, which was about 13 times sales. Still pretty expensive, but not the insane valuation that it was at in 2021. And then I doubled down on this in October of 2022 when it was just over $8 a share, trading at roughly 7 times sales, which at that time was sort of middle of the road for a SaaS company. So at that valuation, I thought it was a very fairly priced company. And so this really goes to show why buying at moderate valuations can be such a successful endeavor. Because if we look since then, you know, just since my first purchase here, it's up 230%. It's up even more from when I averaged down in October. And, you know, today it's trading at $42 a share, which I'll be honest, I think is, you know, potentially bubble-ish territory. It's very expensive. I would not be buying it today at $42 a share. But my cost basis is so low now, I can afford to average up on the stock. Which means even if I pay $42 a share today, my average price will still be below $20. So I'm still in a really good position going forward. And so that's really the 3 big lessons that I learned from my awful investment in Beyond Meat, how I've applied them to Palantir and some of my other successful investments in the past 5 years. And if you want to see a bit more of a deep dive of how I analyze companies and how I decide which stocks to buy, there's going to be a linked video at the end of the screen. It's going to be my deep dive on Broadcom, and that will give you more of a feel for how it is that I actually look at companies to either buy long term or sell puts on for the purpose of income. So, hope you enjoyed this video, and I'll see you in the next one.